What happens when the suppressors become the supporters? When the enemy becomes your ally? This morning, the financial world witnessed something that precious metals investors have been waiting 40 years to see. A PDF file released by the US government just confirmed the most significant shift in the silver market since the Hunt brothers tried to corner it in 1980. The banks that have spent decades keeping silver prices artificially low have switched sides. JP Morgan, Citibank, and the other major US bullion banks are no longer fighting against rising silver prices. They're positioned to profit from them. This isn't speculation. This isn't conspiracy theory. This is official government data from the Commodity Futures Trading Commission, and what it reveals is both shocking and historic. The paper ceiling that has capped silver for generations has been removed by the very institutions that built it. But here's the terrifying twist. If the suppressors have stopped suppressing, someone else must be holding the bag, and that someone is about to face the mother of all short squeezes. For decades, the silver market has been controlled by a handful of massive US banks. Every month, the CFTC releases a document called the Bank Participation Report, and for years it showed the same pattern. US banks holding enormous net short positions, sometimes 30,000 or 40,000 contracts. This short position acted as an invisible ceiling on silver prices. Every time silver tried to rally toward $30 or $40, these banks would unleash waves of paper contracts to push it back down. But the December 2025 report shows something unprecedented. U.S. banks now hold 18,611 long contracts and only 17,138 short contracts, giving them a net long position of 773 contracts. This number might seem small, but its significance is enormous. It represents a complete reversal of strategy. For the first time in modern history, the biggest players in American finance are betting that silver will rise, not fall. Their incentive structure has completely flipped. This transformation marks the end of a 40-year suppression campaign that has defined the silver market since 1980. When the Hunt brothers attempted to corner silver and drove prices from $6 to $50, the exchanges changed the rules mid-game, forcing liquidation and bankrupting the Hunts. In 2011, when silver hit $50 again, 5 margin hikes in 9 days crushed the rally and sent prices plummeting to $26 within weeks. In 2020, JP Morgan was fined $920 million by the Department of Justice for spoofing, admitting to placing fake orders to manipulate precious metals prices. These weren't isolated incidents, but rather a systematic pattern of control. The banks acted as gatekeepers, ensuring that silver never threatened the dominance of the dollar or the existing financial order. But now, after 4 decades of fighting, they've laid down their weapons. Not out of morality or fairness, but because they've recognized that continuing the war would be suicidal. While U.S. banks were frantically covering their shorts and flipping to long positions, someone had to take the other side of those trades. The December report reveals that foreign banks increased their short positions to a staggering 43,084 contracts, representing over 215 million ounces of silver. This is 25% of annual global mining production. European banks, Canadian institutions, and Asian state banks have absorbed the entire short position that U.S. banks abandoned. They're not hedging or playing defense. They're catastrophically exposed at the worst possible time. Silver is trading at all-time highs near $67. The physical market is in deficit. Industrial demand is surging, and their biggest allies, the U.S. banks, have deserted them. These foreign institutions are now sitting on what amounts to a financial time bomb. When silver moves to $70 or $75, they'll face billions in margin calls, forced to post more collateral or face liquidation of their positions. The current situation didn't emerge from vacuum, but from a long history of manipulation that investors have documented and fought against for generations. The Hunt brothers' 1980 attempt to free the market ended with rule changes and bankruptcy. The 2011 rally was destroyed by coordinated margin hikes that appeared designed to kill momentum rather than manage risk. JP Morgan's $920 million fine for spoofing wasn't speculation or theory. It was a criminal confession admitted in court. For 40 years, these banks used algorithms, high-frequency trading, and fake orders to suppress prices whenever silver threatened to break free. They employed waterfall smashes at 9 in the morning, mysterious dumps during thin trading, and massive red candles appearing from nowhere to kill rallies. But if you look at recent price action, these tactics have disappeared. Silver is trading normally, rising and consolidating in healthy patterns. The manipulation has stopped not because the banks found ethics, but because they've changed sides and now profit from rising prices. This isn't coincidence or accident, but rather a calculated strategic move that amounts to financial warfare against competitors. U.S. banks faced a choice: continue fighting physical reality and eventually blow up, or sacrifice foreign competitors to save themselves. They chose survival. By flipping long, U.S. institutions have weaponized the silver price against rival banks. When silver hits $70, J.P. Morgan makes money while European and Asian banks hemorrhage capital. At $75, foreign banks will be forced to sell stocks, bonds, and gold just to meet margin requirements on their silver shorts. They'll receive calls from exchanges demanding more collateral immediately. And who's driving prices higher? Physical stackers, industrial buyers like Samsung, solar panel manufacturers consuming 30% of supply, and now the U.S. banks themselves. J.P. Morgan can watch the price rise while their competitors squirm, with zero incentive to stop the rally and every reason to push it harder. They want to force a cascade of margin calls. The physical fundamentals underlying this financial shift make the situation even more explosive and unsustainable for the short sellers. Samsung has been buying mines directly to secure supply for their electronics manufacturing. Solar panel production consumes 30% of annual silver supply, and that percentage is growing. J.P. Morgan reportedly owes China 129 million ounces from various derivative contracts. The supply-demand imbalance was already severe enough to send silver toward $100 based purely on industrial consumption and investment demand. The vaults that once held massive inventories are being drained. Lease rates are soaring as available metal becomes scarce. This physical reality is what finally convinced U.S. banks to abandon suppression. They could see the writing on the wall. You cannot hold a beach ball underwater forever. Eventually, the pressure becomes too great and it shoots to the surface. The banks realized that fighting this physical shortage would destroy them, so they stopped fighting and started buying instead. The CFTC report only covers the visible COMEX futures market, but beneath that lies the massive over-the-counter derivatives market estimated to be 10 times larger. This dark market includes swaps, forwards, exotic options, and private deals between banks that are unregulated and opaque. If U.S. banks were terrified enough to flip their public positions on COMEX, they've almost certainly unwound their private positions in the OTC market as well. They're scrubbing their books clean, de-risking decades of suppression schemes because they know a reset event is coming. This explains recent volatility in platinum, strange movements in vault data, and soaring lease rates across precious metals. The banks are frantically untangling themselves from commitments that could destroy them. Analysts tracking these flows have asked whether the major U.S. banks have closed out trillions in silver short positions in derivatives markets because they know the final endgame has arrived. The evidence strongly suggests yes. What happens next is a feedback loop that becomes self-perpetuating and accelerates with each iteration. Algorithms that track CFTC data will read this report and see U.S. banks net long, triggering buy programs across hedge funds. Algorithmic buying squeezes foreign banks harder, forcing them closer to capitulation. When foreign banks finally start covering their 215 million ounce short position, they must buy in a market with no available metal, sending prices vertical. Higher prices trigger more physical hoarding by investors and industrial users who panic about availability. Each cycle intensifies the next. We could see $50 moves in a single day when the cascade truly begins. The U.S. banks, architects of this system, position themselves perfectly. They're sitting back watching their competitors burn, while their long positions generate billions in profit. For 40 years, investors traded against J.P. Morgan and lost. Now, for the first time in history, you're trading with them. They want prices to rise. They need prices to rise. The era of cheap silver died with this report. Welcome to the era of true price discovery. The signal everyone has been waiting for has finally arrived. When the very institutions that built the suppression system decide to flip sides, it tells you everything you need to know about what's coming. The U.S. banks have seen the internal data. They know the vaults are empty, the mines are sold out, and industrial demand is insatiable. Most importantly, they know their foreign competitors are trapped in a position that cannot be covered without sending prices to levels most people think are impossible. The paper wall at $50 is gone. The suppression tactics at $60 have been abandoned. The ceiling at $70 has been removed by the banks themselves. We're entering uncharted territory now, a vacuum zone with zero resistance above. The mathematical inevitability of $100 silver is no longer a dream. It's a conclusion drawn from official data. Monday morning, when markets open, the algorithms will react. Foreign banks will scramble. Industrial buyers will panic. If you aren't already positioned, you may never catch this move. Hold your metal, watch the fireworks, and whatever you do, don't blink. History is happening right now.